QuickBooks Online 2025 check and expense form. Get ready and some coffee because we're learning how to save time with QuickBooks Online and space because we're on the cloud and so we don't need ledgers everywhere. So we're saving the entire space time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample file available to everybody looking for a result that has intuit.com and the URL Intuit being the owner of QuickBooks, thereby giving us a little bit more assurance we're in a nice and legitimate location. We're in the sample company file, Craig's Design and Landscaping Services, opening the financial statements like we do every time with the reports on the left. Then we're going to go into the favorites and right click on that balance sheet, one of the favorites. We're going to open up in a new tab, right click on the profit and loss, otherwise known as the income statement, open in a new tab as well. Tab to the right where that balance sheet is now located, closing the hamburger for better visualization. Changing the range for a 2-year time frame, 01/01/24, tab 12/31/25, so that I can select the drop down, pick years, run it to refresh it, and we've got 2024, 2025 side by side. Let's go to the tab to the right, close up the ham boogie again so that we can boogie with a range change. 01/01/24 tab, 12/31/25 tab, select the drop down. We want it in years again, run it to refresh it, noting that there's nothing in 2025 at this point in time, beginning of 2025, except for that $34, including the information that we had entered in prior presentations because we're refreshing the data each time. So if you want to follow along, you can refresh the data so it will reset, possibly having to open it in incognito window so it doesn't save the data with cookies. Otherwise, you'll be okay if you have that prior data in there, most likely anyways. Let's go to the first tab. We're now going to be thinking about, let's select the drop down, the vendor section. So we've been looking at forms in the vendor section. We looked at the bill form, increase in accounts payable, pay bills, pays down the accounts payable, the purchase order, a request for inventory. Now we're going back up to the bread and butter of the expense cycle, which is in essence a check form. And the reason I say it's a check form is because that's the form that should kind of come to mind typically when we have a decrease to the checking account. Now, I realize that these days we don't often write physical checks, although you'll have some businesses that still really insist about doing that because you have owners that feel comfortable with paper checks still. But more and more, we have online electric transfers. But we can still kind of think of it as a type of check form if the check form is the form that's going to be decreasing the checking account as it is with our data input forms. So in other words, when we think about a check type form, we can think again of the normal parlance, which would be an actual physical paper check that we imagine giving to somebody. But when we do the data input into QuickBooks, we're thinking about the data input form that is used in order to create the transaction that's going to impact the financial statements, the check form being the one that's going to decrease, in essence, the checking account. So that said, we've seen that there's multiple types of check forms that are trying to give us more information. There are pros and cons to QuickBooks using these different types of checks forms. The plus is that just by the form used, I get more information about the transaction. The minus is that now I have all these different forms that are really just all decreases to the checking account, which I could have done with just one form, simplifying the process. So in other words, we've got a check form, which is basically the same thing with a check number. We have an expense form, which is in essence a check form that doesn't have the check number. We've looked at the bill pays form, which is a check form that specifically pays down the accounts payable. And we also looked at the idea that we had the payment of the sales tax using a widget, which will also be a check form typically, that will be a special one paying down the tax. So let me show you what I mean. If I go over to the balance sheet over here and we go into the checking account for 2024, drilling down on that data to get us to, in essence, the general ledger GL, which they call the transaction report. It gives us our nice transaction types over here. Remember that the checking account is where you're going to have more types of transactions than any other account. So in other words, the checking account is the lifeblood of the company. Therefore, it's integrated in all the other cycles, whereas all the other cycles are specialized in one particular area. Therefore, you can have much fewer types of transactions that are going to happen. So notice when you're in the checking account, you would think that you can break down the increases and decreases to the checking account just like the bank does, with basically just increases being deposit forms, decreases being check forms. And that's basically what we have here. We've got the deposits increasing, but then on the decreases, we've got this one is decreasing. That's called a bill payment form, but it's basically a check type form, as you can see in the description. And that will tell us that it's paying down accounts payable. You can see the other side here going to accounts payable, right? And then you've got the payment. You've got an expense form, which is like a check form, but doesn't have a check number. That's possibly the most common one for many modern businesses, not any longer using a checkbook. You have an actual check, which is the same type of form, decrease in the checking account, but it has a check number in it. You've got the sales tax payment, which again is a type of check form in essence, decrease in the checking account, but it's for paying off the sales tax, and so on and so forth. So that means that when you want to sort by this data, which is often, something that you might do, you might filter by that information, for example. And the common way to filter is by type. So here it is, by transaction type. So we can filter by transaction type, and then look for it is equal to, and then I would have to select multiple of these items instead of just one if I want to see the decreases, right? Here's the check form. Here's the credit card bill payment, the expenses, and so on and so forth. So I have to. That's the problem with it. If I want to just filter all this to the decreases, I have to pick all the different kinds of check forms, which is kind of a pain. But on the plus side, if I just look at the actual form, I can basically know what the transaction is doing. So I'm going to say save and exit without saving, boom. All right, let's go back to the first tab. Let's hit the plus button again. So let's look at the difference between an expense form and a check form. Now the check form is now the easiest thing. And this is what, if you're trying to automate your accounting system, what you would like to get your client to be using, electronic transfers, because then we can automate the system with check forms and get a lot more information and use the bank feeds optimally. If they're still writing physical checks, which again, a lot of older types of businesses are comfortable with, that works for them. They feel like it's the securest way. They have a paper trail. They have a physical thing. So it's going to be difficult sometimes to try to get some people to go into electronic transfers, and maybe you can have a specialty in that area where you still deal with physical checks. The problem with physical checks, however, is that we can't wait till it clears the bank to record the transaction. We're forced to really do a full service accounting system because we want to be tracking the outstanding checks. So when we actually physically write the check, whether we write them by hand or print them out of the QuickBooks file, I want to create the check form when we write the check so that I can track if and when it cleared the bank. Whereas the expense forms are going to be for the electronic transfers, which I can enter at the point in time I actually pay for something. However, it's a lot easier and I have more assurance by just waiting until it clears the bank. Not more assurance, but more assurance than with a check form, because the time frame of when I write an electronic transfer and it clears the bank is only going to be 1 to 3 days. Whereas if I write a physical check, the turnaround is going to be, could be weeks to months before the check actually clears the bank. So that means that this expense form, electronic transfers, gives me the information in order to automate the process with bank feeds, which is going to be the fastest way to save time for most small businesses. So a quick recap in our flow chart over here. Remember, we're on the vendor side of things in the cycle. This is, by the way, the desktop flow chart. I'm using it for online purposes because it's a flow chart and all accounting systems are basically the same. It's just giving us the arrows so we can see what is happening. So if I'm using the bank feeds, I have to think about how it's going to integrate, and you want to think of it by cycle. How is it going to integrate into the vendor cycle, the customer cycle, the employee cycle? Remembering the vendor cycle is usually the easiest cycle to integrate into. So if I can say I'm going to make all electronic transfers, and for everything I pay, utility bill, the phone bill, and so on and so forth, then I could use a check type form instead of a bill payment type form, not actually physically enter the transaction when I make the payment, but wait till it clears the bank and depend on the bank basically entirely to create our bookkeeping system. We don't have as much assurance doing that because really for a full bookkeeping system, we want to enter it and then the bank enters it and then we reconcile, giving us an internal control. However, it's a lot easier to just let the bank do it and then pull it into the system. And that's going to save time and hopefully give us the information we need for end of the year financial reporting and taxes. So let's see what that basically would look like. If we go into the transactions tab over here, that's where our bank feeds are located. I'm going to close this out. I'm going to close up the hand boogie. We're in the first tab, the transactions tab. You have your checking account here. So this is what I would call bank feed limbo. And what's going to pull in here from what I would call bank feed limbo is going to be from the decrease side of things, the amount of the payment. If it was an electronic transfer or check, we would have that. It's going to be the date. Now, if it was a check, the date's going to be far after the date that we actually physically wrote the check. But if it's an electronic transfer, it'll be very close to the day we actually made the payment. So that's why it works well for electronic transfers. And if it's an electronic transfer, we might have information in the memo. Oftentimes we do. That memo information might not be specific or perfect, but it often will give us the information necessary to determine who we paid with the transfer. In other words, it'll have Verizon if it was a telephone bill. It'll have, whoever our Spectrum or whatever our cable company is in the memo. We can take that information and use it to give us the one key piece of information we don't know in order to record the transaction. That's going to be the category, otherwise known as the account, such as telephone expense, utilities expense, and so on. And it's going to give us the information that we might not necessarily need to record the transaction, but should be putting in place so that we can track more information if we need to, that being the payee, or in this case, the vendor who we paid the money to, so that we can track by vendor item. So let's first think about that form by entering it this way. Let's enter a check form and see the transaction fields in it. So I'm going to enter a check this time. That's going to have an actual physical check with a check number in it. And we're going to say that we're going to pay it to, let's make up a vendor. Let's just say Verizon. So I can make it up as we go. We can see all the pieces being put together. Verizon, that's who we're going to pay again. And it's going to come out of the checking account. So we only have two accounts here, the checking account and the savings account. So usually we'll be paying out of the checking account. We'll make it on 1-3, that's fine. Now notice we have a check number here. If we're physically writing checks, then you can write the check by hand even, but you also want to enter it when you write the check, and the check number here should tie into the actual physical check you're writing. If you're using printers to print the checks out of QuickBooks, then you're still gonna have to buy the physical checks, which will be on paper stock with pre-numbered check numbers, which is an internal control, which you then have to put into the printer and print them out on once you create the checks, which you can do here and print later. Oftentimes it's useful to print them later if you're doing that, because then you can print them all at one time, right? You can write a bunch of checks and then print them hopefully out at one time, as long as you've got the checks properly orientated in the printer. Tags, we're not going to be adding tags here. Then we have the categories. Once again, you've got the two kind of categories. We've got the category here, and then you've got the items. Just like we saw with the bill form, noting this check form looks a lot like the bill form, except that instead of increasing the accounts payable, we're decreasing the asset of the checking account. So we could put it into a category detail, which gives us the account, such as utilities, telephone, and so on, or an asset account like property, plant, and equipment. And then if it was inventory, we'd have to add the inventory item to purchase the inventory down below. So let's imagine here it's going to be in the category. We're just going to put it into telephone. Now, once we've entered this a couple times, then the next time I write a check to Verizon, it'll most likely save the data, the transaction. And that's part of the memorization process that will happen here. It'll also happen within the bank feeds. We can make bank feed rules, totally automating this process, hopefully. All right, we're going to say it was for, let's say, just good old $100. Then we could once again make it billable and add a customer. Why would we do that? Just like we saw with the bill, we might do that in order to pull this into an invoice. In other words, I might say, I'm charging this telephone expense that I had here to a particular invoice to a customer. More likely, we would do that with like gas mileage that we're using or supplies that we are purchasing for a particular project for a particular customer, so that when I create the invoice for the customer, I can pull the actual expenses in to the invoice and then possibly have some kind of markup system for my revenue. So we talked about that a little bit with the bill, so I won't go over that again here. And then down below, we've got the memo we can add. We can add attachments. So if you're buying something like property, plant, and equipment, you might want to add the attachment because you might want to give this to your accountant at the end of the year and give them as much detail as they need to put this on like the depreciation schedules. Otherwise, you might not need it because you have a nice audit trail of at least the check, the physical check that's being written, or if an electronic transfer with the electronic transfer that's being made that gives you pretty good audit trail because it gives you the transfer as well as the transaction data. We can cancel clear, we can print the check, we can order checks, we can make it reoccurring, we can void it here. Then we have the save and close or the save and new. I'm going to record it. What's this going to do when I record it? It's going to decrease the checking account, and the other side is going to be going to the telephone expense. And by the way, let's just look at that here in a journal entry. Let's imagine we made a check form. What's the journal entry for a check form in our simple transaction? I'm going to put $50,000 in cash. This is our so we can see it in a more transparent way. Negative 50,000. What would happen from a journal entry standpoint? We would have the expenses. I'm just generically going to call them expenses of $100 on the debit, and the other side is going to be cash, which is going to go down with a credit. And if I post that, cash goes down with a credit, right? And then we've got the expense generically posted to expense, which is part of the income statement. It goes up with a debit, and then income minus expenses would bring net income down. So net income went down, and we were in balance before, we remained in balance afterwards. Let's see that in QuickBooks. So now let's post it, save and close, and check it out. Let's go to the balance sheet, and we will run it to refresh it. And then if I go into this checking account, drilling down to check out the checking, there's our check form, 71. Let's go into that item, boom. And so then now we've got Verizon, there's our check. Let's close this back out, and let's go up and go back. And then the other side's on the income statement. And let's scroll up, run it to refresh it. And then in 2025, we should see that one pulling in. There's the $100 telephone, boom, and bam. So there, for some reason, it's your selection doesn't. All right, I'm just going to say we see it there. We see it there. I see that. Okay, so that's going to be the idea. So then if I go back to the first tab, what's going to happen with the bank feeds? Well, if it's a physical check, then this information pulled into the bank from what I call bank feed limbo. If it's a physical check, we already wrote the check. So what's going to happen when it pulls in here? Is it going to record it 2 times? And no, hopefully it's not going to record it 2 times. Instead, what it's going to do is say, hey, look, I see that you already wrote the check. How does QuickBooks know that? Because it can match up the number, the check number that we wrote, and the date pretty easily, and the dollar amount. Between those 3 things, QuickBooks should be able to hopefully determine that we can match that out to what the check that we wrote. So when we use the bank feeds in this system, we would use them as a check to show that the transaction has actually cleared. So in other words, if we're physically writing checks, we have the added problem of like the telephone company coming back to us and saying, you didn't pay us. And then we'd have to go, okay, what if that happened? I'd go in here and go into my expenses center, and then we would go and we could go into the vendors, and I can say, all right, let me look for Verizon down here. Verizon, there it is that we just added at the bottom. And then I can say, look, I see that I wrote a check right here that is right here. So I've written a check. But then we have the added problem of, did the check clear or not? Because maybe it got lost in the mail. How can I check that? Well, then I have to check my bank feeds or possibly go online to see if it cleared the bank. If it cleared the bank, I could say, hey, look, it cleared the bank. Somebody cashed the check. Or if it didn't clear the bank, I can say, I don't know, we wrote the check, we sent it out, it got lost in the mail. And then the question is, should we void it and write another one? All right, so what about on the expense side of things? If an expense form is going to look very similar, if I hit the plus button up top, the new button, let's look at an expense form by comparison. Close in this one up, and let's say this one is going to just generic vendor 1. So it's an expense form. But it's gonna look a lot like a check form, right? It's gonna decrease the checking account. It's gonna we'll make it on the same date. Let's make it 1 day later. Payment method, expense, cash. So now we have an added field because the check form is assuming that we wrote a physical check. But here we have the different transaction types that it could be, which is really not gonna affect the recording, but might give us another data input field. And we might have to add one and say this is electronic or something like that transaction because we're paying it electronically, let's say. And then we could have a reference number if we have one. And then once again, we've got the categories and the items. Let's do an item this time just for comparison's sake. If I have an item, that's one time where, or one of the times where, even if I'm using an expense form and electronic transfers, I might still have to actually physically enter the transaction when I order the inventory item if I'm using a perpetual inventory system, because I'm going to have to track the item that I'm purchasing not only in dollars, but in units, which the bank, of course, can't really do that automatically, right? The bank doesn't know how many units of item you purchased. So let's just call this item 1, generic item 1 again. We're going to copy that. And then it's going to, actually I need to create it. Generic item 1. It's going to be an inventory item. So we'll say that quantity on hand is 0. And we'll say as of here, reorder point at 0. Let's say it's going to go to the inventory account. And we're going to say it's going to be description item 1. We're going to say that we sell them for, let's say, 150 this time. And let's say sales tax is applicable. We're going to buy them for, let's say, 75. So we're going to buy them for 75. What are we doing now? We're buying them. We're buying the inventory for $75 each. Let's save it. And let's say we buy 3 of them now just for quantity's sake. So that comes out to $225 that we're going to be spending. So what's this going to do when we buy it now? Let me just show you on a form over here. It's same. Now we have an expense form. So this is an expense form. And we're buying inventory. I'm going to delete this one. What's this one going to do? It's going to say, well, the checking account is still going to go down. And this was for, how much was it? For $225. So negative 225. But the other side is going to go into inventory, an asset account instead of an expense account. So now we've got inventory going up and we've got cash going down. Hopefully I did that right. Right, so inventory goes up, cash goes down. Now this inventory, I need not just the dollar amount here, but also the subledger of the units of inventory. Let's check that out. So if I go back on over here, I'm going to say, all right, we're going to post it, save and close it. Let's go to the balance sheet and we'll say run it to refresh it. Let's go into that checking account for 2025. Boom. There's our check form. Where's the inventory one? There it is. I refreshed it for some reason. So there's the check and there's the expense. They're both decreases, so they're doing, in essence, the same thing. If I go into it, there's our expense form. Closing that out, let's go back. And now we're going to go into the other side, which isn't on the income statement because we had to do an accrual thing, buying inventory. So let's go into that inventory, ba-boom. And so now we have the inventory item that we purchased. Inventory value, let's go, so there it is. So there's the 225, so it increased here. All right, let's go back up top and just look at the subledger just to get an idea of the subledger. We'll talk more about inventory later, but for that, I'm gonna go to the reports on the left-hand side, type in inventory valuation summary, look up that one. Let's do it. I'm just gonna go as of the end of the year, 12/31/25, run it to refresh it. And you can see now we have the 3 units of the items of inventory, giving us the number or units of inventory and the values at the 8/21/25, which should tie out to what's on our balance sheet, 8/21/25. Okay, so if I go back to the first tab and I go back to my transactions, how does that fit in the bank feeds? Well, if I had to still physically enter the transaction myself because I was buying inventory and therefore I wanted to track the units of inventory, then like the check form, this information would pull in from the bank feeds and I would simply match it to the check I already wrote or expense form I already wrote, and it wouldn't record anything new but help us with the bank reconciliation, which is still important for us to do. But what if I had this one, like if I'm paying the rental company and this one I'm just going to pay basically with the bank feeds. So if I paid it with the bank feeds, I can say, all right, let's go into this one and say, it's just going to be a category. Now notice this doesn't look like an expense form, but it has all the information in essence for an expense form. So the vendor will typically be something like in the memo where they put a rental. So we'll just say, we'll make it generically rental place. But it would usually have the name of who we paid because it was an electronic transfer. And then the category is going to be rent or lease, expense, let's say. And then we can select product or services if we want to make it billable and so on. And basically that's it. Now we could also make a rule for it so it can save it going forward. We'll talk more about that in the bank feeds. But notice this transaction is going to record something new to the financial statements, whereas the prior to, we would have to match. I would match it to what we already did. So let's check this one out. This one happened on 1/3. So 1/3 rental, we'll say add it. And then let's go to the balance sheet and check that one out just to see that it's the same form. Go into it. And so I'm going to say on 1/3, let's refresh it again. So here it is on the rental place. So I just want to point out that this recorded the same transaction and expense form. If I go into it, it's not going to look like the bank fee transaction. It looks like a full expense form, right? It looks like the full expense form normally would. And the other side, of course, went over. If I go up and back, went to the profit and loss. If I run that again into somewhere in the rental, so it went down here into the rental here. So it recorded the transaction. So that's going to be the general idea with the expense forms. So if I go back to the first tab, hit the plus button, the general idea with the expense forms, every form that decreases the checking account, you can think of as generically a check type form, but you might have special names which help determine what exactly the transaction is, one of them being the expense form, which basically usually means that you have electronic transfer rather than a physical check. Same form, it just doesn't have the check number in it. And just remember that if you have checks, physical checks that you're writing, you want to enter the transactions when you write the check, because you need to track the outstanding checks as to when they clear the bank. That's going to be a critical component. But if you do electronic transfers, you might wait till the transactions clear the bank and actually use the bank feeds in order to record them. That's going to be a huge part of automation, which is something that a lot of bookkeepers can do and provide value with by sacrificing a little bit of security and a little bit of the double entry accounting system, a little bit of internal controls for the simplicity of basically just building your books from the bank account. However, you're not going to be able to do that possibly with certain transactions that still need an accrual component, such as maybe when you're dealing with the purchase of inventory and tracking that inventory on a perpetual inventory system within the accounting system. So the next thing that's going to happen with this is you're going to have to do the bank reconciliations. We'll talk about reconciling at a future time, but cash is going to be super important in the lifeblood of the company. Reconciling cash gives us assurance about the entire accounting cycle. If you create your entire books from the bank, reconciling will be extremely easy, but still necessary so that you don't have duplicate transactions or missed transactions. And if you actually write physical checks or have to do more of an accrual process, you're going to need to reconcile still, just like you kind of normally would under a bookkeeping system. It'd be a little bit more complex, so we'll talk more about that in future presentations. And just note that when you're tracking the check forms, if I go to the expense center down here, if you're just paying like the telephone company, like we talked about before, you're probably not going to need to go in here that much because you're not tracking the bills. Normally, you're in here tracking the bills. If you just paid with an expense or check, then you might go over here and you can sort by the check forms, the expense form, boom, and filter and sort by the expense if you want to look those up. Or if a vendor like asked you a question like, did you pay us? Then again, we can go to that particular vendor over here and say, well, we paid you with a check or an expense form. If we paid them with an expense form, we're pretty certain it cleared the bank because we did an electronic transfer. If we paid them with a check form, we have the added question of, did it clear the bank? That we might have those questions come up here. But we don't have the question that will always come up if we're doing bills, which is that we have to sort the bills and then basically pay the bills, at a later point in time, which will create a type of check form at the time of the bill payment, but it's more specific. It's that bill payment check form that we talked about before.